Yeah. Good evening, students. Welcome to the session. Yes, I hope you have revised because there has been a gap of few days in between the lectures, and I hope you have revised the session, what we have done last time. So we are pending with deductions, and we would finish it off that first, and then we are going to start with the assessment of the various entities as a topic. Okay, is that clear? So let's quickly start with the deduction part first. So if you remember, what was left was basically the 80 JJB. We had done till 80 RRB, right? We had done till that, and now we are left with 80P, 80 JJB. All of these deductions we have to cover. Yes, Rashmi, Kaushiki, good evening. Yes, okay. So let's get quickly started. In case you have any questions, if you have revised during the after the last class, basically, you could ask me the questions. Otherwise, we straightforward proceed with the lecture. Okay. Okay. So let's get started. Yes. So first section, what I'm going to cover now is 80 double J double A. Okay, now this is particularly the section which is there for the new employees which are hired. So in order to encourage the new employees, this particular or the employment opportunities, this particular section has been inserted in order to give the incentive to the companies. Okay. Now, what does this section particularly provide? Let's try and understand. Okay. Give me a moment. Yes. $80 double J double A. This is the section what we are going to deal with now. Now, what does this section say exactly? As I said, this is for the incentive to the companies to create the employment opportunities. And for this purpose, only this particular section has been created. Now, 80JJAA says that where the total income of the assessee, it is applicable to the eligible assessee. Now, who is the eligible assessee here? The eligible assessee is assessee who is required to do the tax audit. Assessee to whom section 44 AB applies. Right? Includes any profit or gains from the business. Now, this is applicable to section 44 AB assessee, and the conditions here are that the business should not be formed by splitting up or the restructuring of the existing business. So what is the conditions? It should not be the case that I have the employees hired from my earlier business only in order to claim this deduction. So the business should not be formed by splitting up or reconstruction of existing business. Okay. The business is not acquired as a result of any business reorganization. So, business is not acquired by way of transfer or as a result of reorganization. Okay. So business should not be acquired by way of any reorganization. And as I said, the assessee should be required to get the tax audit done. That is 1 month prior to the due date of return of income. Now, what is the deduction which is available over here? The deduction which is available over here is 30% of the 30% of the additional employee cost. 30% of the additional employee cost incurred in the business. So that is what the deduction here is. Now, if you see what is the additional employee cost, so that is clearly defined here. What is the additional employee cost? Let's try and understand. Now, the additional employee cost in this particular case is defined that the total salary which is paid to the additional employees employed during the previous year. So, total salary which is paid to the additional employees employed during the previous year. So, in case it is a new business, the salaries which are paid to the employees employed during that particular year, that will be the additional employee cost. In case this is an existing business, then whatever the additional number of employees are hired in that year, that particular cost which is there, the salary cost which is there for them, that for that amount, 30% of that amount will be allowed as deduction. In case there is no increase in the number of employees from the total number of employees in the last year, then the additional employee cost will be nil. The additional employee cost will not be considered, or it will be considered as nil where the salaries are paid otherwise than by the account pay check or the draft or ECS or any other digital payment mechanism. So you can write it here. Additional employee cost shall be nil if salaries paid otherwise than by account pay check or ECS or digital banking system. Okay, then it will be considered as nil. Now, what is the meaning of the additional employees, or who are the additional employees which are considered for the purpose of the deduction? But before that, as I said, this particular amount will consist of 30% of the additional employee cost. Now, what is additional employee cost? Additional employee cost is the salaries which are paid to the employees in terms of the additional employees which are hired during the year. But the salary portion will not include any contribution to the pension fund or PF fund or any other ESIC which is for the benefit of the employee, or any contribution which is towards the termination of the service or superannuation, voluntary retirement, gratuity, all of that will not be included. So in the employee cost, what will you consider? Employee cost includes any emoluments, that is any sum paid excluding contribution to PF or pension fund or ESIC and retirement payments. Retirement or termination payments, you can write. Right? Gratuity, superannuation, all of that will not be included. Now, who is the additional employee? An employee who has been particularly employed during that particular year. But the additional employee will not include excludes. Who is excluded from the additional employee? Employee whose salary is more than 25,000 per month. 25,000 per month. Right? An employee for whom the entire contribution is paid by the government under the employee's pension scheme. So meaning the government employee, right? Under pension scheme. Then employee who has been employed for less than 240 days during the previous year. Employed for less than 240 days. This will be considered as 150 days in case of the business is of manufacturing of apparels or footwear or leather products. 150 days in case of manufacturing of footwears, apparel or leather. Right? So if an employee is employed for less than 240 days or 150 days, then in that case, this will not be considered. Right? But there is a condition also here, or there is one more possibility here, which is that let's say if an employee is employed for less than 240 days or 150 days during the year, but in the next year, he is employed for more than 240 or 150 days. So if the employee is employed during the previous year for less than 240 or 150 days, but is employed for a period of 240 days or 150 days in the next year, he shall be deemed to have been employed in the next year. Accordingly, the employer would be entitled to deduction of 30% of the additional employee cost for 3 years from the next year onwards. So let's say this year the employee would have joined, but he would have joined say in the year end, and therefore he would have not completed 240 or 150 days. But he is present even in the next year. So the deduction will be available in the next year. If employee employed for less than 240 or 150 days in current year, but employee for 240 or 150 days in succeeding years, then deduction for 3 years from succeeding years. Are we clear? So this deduction is basically available for a period of 3 years to the employer. Right? So this will be allowed for the period of 3 years. Allowed for 3 years. Right? So any questions so far? Any doubt, any questions? No, so you will get Kaushiki for the additional employees you're hiring. Even if you fire 50, you're hiring 50, then here the condition is that you should have hired more than you should have hired the employees during the year. It is not the condition that you should not have fired some employees. You cannot fire the same employees because there's a condition of 240 days for that particular employee. So that condition always remains. So if the employee is employed for less than 240 days, then you will not get this particular deduction. Clear? Any other question? So this particular deduction is available to the assessee who is required to get his books of accounts audited. Deduction is 30% of the additional employee cost. Additional employee cost will be nil, where in a case there is the payment of salaries other than the account paid check or electronic mode. Right? What is the salary cost? Salary cost is every cost what you are paying, excluding the contribution of the employer to the PF or pension fund, or any lump sum payment at the time of termination or retirement, right? Then here, who is the additional employee? The employee who is employed during that particular year. But if the salary is 25,000 or more, or if he is employed for a period less than 240 days, or who does not participate in the recognized provident fund, then write it here. Employee not covered by recognized provident fund. Then in that particular case, you will not get that particular deduction. Clear? So employee who does not participate in RPF will also not get this particular deduction. So you will get 30% of the employee cost as the deduction. Clear? Any question, any doubt, anything you would want to ask? Okay. Kaushiki, we will not talk about budget because your budget is not relevant for your attempt particularly. Okay. So we will not be discussing that. Okay. So shall we solve one small question from your module only so that you get a hang of this? So this particular 80JJAA will not come in isolation, but this will be part of the entire comprehensive question which will be coming for the computation of total income. So there you will have to calculate this particular amount. Okay. So shall we discuss one question on this? Okay, let's discuss. So I'll share the relevant portion from the module only so that you can solve this particular question. Let me just share the screen. Okay. Mr. Vikas has commenced the business of manufacture of computers as on 1/4/21. He employed 420 employees during the previous year 21-22, the details of whom are as follows. So 75, 125, 120, 100, date of employment is given. They are regular or casual, that is given, and total emoluments per employee is given to you. The regular employees participate in the recognized provident fund while the casual do not. Compute the deduction, if any, available to Mr. Vikas for AY 22-23 if the profits and gains derived from manufacture of computer that year is rupees 90 lakhs and his total turnover is 11.48 crore. What would be your answer if Mr. Vikas has commenced the business of manufacture of leather products on 1/4/21? So quickly, let me know the answers. That depends on the facts, Jacob, who got suspended and then got reinstated, for how many days he was present. That's more the important criteria. Quickly tell me the answers. No, Kaushiki, that's not the correct answer. No, Nikhil. You're making some mistake. Okay, let's solve it together. First of all, tell me whether these 75 employees which are there, whether these are eligible or not. So these 75 employees who are employed on 1/4/2021, who have the salary of 24,000, whether they would be eligible or not. These 75 employees, whether they are eligible or not. Yes or no? Yes, eligible. Correct, Kaushiki. Yes, Nikhil. So these are the eligible employees, right? 75 employees, because their salary is also less than 25,000 and they have been employed for 240 days or more, right? No, Kaushiki, even 1,51,000 or 15 lakh is also not the correct answer. Jacob, no. 42 lakh is also not the correct answer. Nikhil, no. Okay. Yes, Jacob, they are eligible, right? Now, this is one set of employee which is covered. So 75 into 24,000 is per month. Into for 12 months, they have been hired. So if you see 75 into 12 into 24,000 is the employee cost for the first set of employees which are hired, right? Now tell me for the second set of employees, 125 employees who have been hired on 1/5/2021, whose salary is more than 26,000, is 26,000, whether they are eligible. No, Kaushiki, even not, that's not the correct answer. 181. Whether the second set of employees are eligible. No. Yes, Kaushiki, correct. Jacob, yes, their salary is more than 25,000, so they are not covered over and for the purpose of deduction under 80JJAA, because their salaries exceed 25,000. Clear? So even if they have been hired for more than 240 days, but their salary exceeds 25,000. Third set of employees, 120 employees hired on 1st July 2021. They are casual employees and the salary is 24,500. Whether they would be covered. Viraj, I just now explained what is the meaning of new employee. The new employee includes the additional employee, but does not include where the salary cost is more than 25,000 and where he is employed for less than 240 days or he is not covered by RPF. Nikhil, yes, you have got the correct answer. That's very good. Yes, Kaushiki, correct. Not eligible to contribute to PF. Yes, Jacob. So therefore, they are not covered for the purpose of 80JJAA as the additional employee. Since they are not participating in the recognized provident fund, they would not be covered for the purpose of the 80JJAA deduction as the additional employee. So therefore, 120 employees are also not going to be considered. The last one, 100 employees employed on 1/9/2021 who are regular and who have salary of 24,000, whether they would be covered or not. Whether they would be covered or not. Yes or no? No. Covered, yes, Kaushiki, if the business is of manufacturing of leather. Yes, Kaushiki, now you've got finally the correct answer. So the last set of employees, if they have been in the employment for less than 240 days, in the present case, they would not be covered as the additional employee, right? But if the business would have been of the manufacturing of leather, then they would have been hired for, they would have been present for more than 150 days, then specifically, even they would have also been covered. So the second part of the question asks particularly if Mr. Vikas had commenced the business of manufacture of leather, then in that particular case, the last set of employee would also be considered as the additional employee. And in that particular case, 24,000 into 100, because this is per employee cost, into 12 months would also be considered for the purpose of computing 30% deduction. In case of the in the present case, in the case of business of manufacture of computers, here, since they have been employed for less than 240 days, they would not be considered as the additional employee, right? But you would write a note in the examination stating that even though they have been employed for less than 240 days, but in the succeeding year, if they have been present for 240 days or more, then the deduction will be allowed in the succeeding year. The deduction will be allowed in the succeeding year, right? In the present case. In the leather business, it would any which ways be allowed, okay? So therefore, only one employee set is covered, which is the first one, which is 24,000 into 75 employees into 12 months, which comes to 2 crores 16 lakhs, and 30% of that is 64 lakh 80,000, which is allowed as deduction under 80JJAA. So the answer is 64 lakh 80,000. Raja, did you understand now how answer comes? It's not 11 lakh or 1 CR. Clear, Jacob? Any questions? Are you clear about this? Did you, all of you are getting the answer? 64 lakh 80,000. It is only with respect to the first set of employee. In case if he would have been in the business of manufacturing of leather, then in that case, the employee cost would have also included 24,000 into the, how many employees are there? 100 employees for the 7 months. Okay, then that would also have been covered. And in that case, the deduction would have been 30% of 3 crore 84 lakh, which comes to 1 crore 15 lakh 20,000. Yes, your answer is correct, Raja, for the second case. Yes. Jacob, why 12 months? No, I didn't take the 12 months. I took 7 months only for 100 employees in case of leather business. I'm not taking 12 months. 24,000 into 7 months into 100 employees. I'm not taking 12 months. Are we clear? No, Nikhil, it's not 50 lakh 40,000. It's 64 lakh 80,000. And in the second case, it comes to 1 crore 15 lakh 20,000. Clear? Everybody clear? Okay. So let's move on then. Are we clear with this? Okay. Yes, we will not take that. Okay. So let's move forward. Now we are done with almost all the deductions here except ATP and ATPA. and ATM. ATM, I'm going to cover it now. Then ATP, which is deduction in respect of cooperative society, and ATPA, which is for the producer company. Both of these deductions I'll be covering when I'm going to take the cooperative society part in the assessment of various entities. So there will be a linkage therein instead of taking it just now. Okay. So last deduction which I'm going to talk about, which is a very small deduction under section ATM. So that's what we are going to start with now. Okay. So ATM is in respect of the intercorporate dividends. ATM is in respect of deduction in respect of intercorporate dividend. In order to avoid the cascading effect for the dividends taxed in the hands of one corporate which is received from the another corporate, ATM allows the deduction. So ATM is allowed to the domestic company. It is allowed to the domestic company if its income includes dividend income received from any other domestic company or a foreign company or a business trust. So the eligible assessee is a domestic company only and not any other company. And the eligible income here is the dividend income received from domestic company or a foreign company or a business trust. Right? Then in that particular case, the deduction would be allowed here. The deduction would be allowed under section ATM. What is the deduction under ATM? The deduction will be the dividend received from the domestic company or foreign company or business trust is allowed as the deduction. However, the deduction will not exceed the amount of dividend distributed by the domestic company. So deduction under this section would be the amount of dividend received from the other domestic company or the foreign company or business trust, or the dividend distributed by the domestic company itself, whichever is lower. And dividend received here or dividend distributed by the domestic company, whichever is lower, will be allowed as deduction. So let's say, for example, if it has received the dividend of, let's say, 12 lakh. If it has received the dividend of rupees 12 lakh and it has declared or distributed the dividend of, let's say, rupees 7 lakhs. In this case, the company which is receiving the dividend would get the deduction under ATM to the extent of only rupees 7 lakh. Dividend distributed by it on or before the due date of filing the return of income. So dividend distributed by it on or before the due date of return of income under section 139(1). So let's say if I have received the dividend in previous year 22-23, but I am declaring the dividend, let's say in June 23. Let's say I'm declaring the dividend in June 23. Therefore, in that case, let's say if I'm receiving the dividend of 12 lakh and I'm declaring the dividend or distributing the dividend on, let's say, 10th of June of rupees 7 lakh, then the deduction under ATM would be restricted to only rupees 7 lakh. Okay. So let's say dividend I have declared is of 12 lakh distributed by me is, let's say, 7 lakh. This is for previous year, 22-23. This is on, let's say, 10th of June 23. Then deduction under ATM would be 7 lakh. Are we clear? Deduction under ATM would be 7. Okay, fine. So this is ATM section. Just remember, again, this could be part of the adjustment as a part of the comprehensive question itself. Okay. Any questions, any doubt? Jacob, do not leave the space. What we'll do is we will write it when we will be doing the assessment of various entities. So no need to leave the space in the book as of now for ATP, ATPA. Okay. Okay. So let's proceed further then towards the next topic, which is assessment of various entities. Okay. So let's quickly start it with it. Now here, what we are going to cover is in the assessment of the Nikhil, no, we are covering all the amendments here only. So you can just note down the amendments wherever I'm telling you. Okay. Yes, Kaushiki, dividend received not necessarily will always be less than dividend distributed. Dividend distributed could be more also. It depends on what income I am earning. It doesn't depend on how much dividend I have received that I would distribute it. Clear? So dividend distributed could be more also, but in any which case, it would be restricted to the dividend distributed, the deduction amount. Are we clear? Any other questions so far? Okay, perfect. Now, in the assessment of the various entities, what we are going to discuss is, here we are going to discuss about different entities, for example, REIT, securitization trust, AIFs. Then we are going to discuss about the companies, then the special schemes which are there for the companies, for the individuals. All of these things we are going to discuss here. Okay. So let's get quickly started. Okay. So first we are going to discuss about the companies here. First topic, what we are going to discuss here is about the companies. Now, in the case of the company, what are the tax rate which are covered over here, or what are the different tax rates? So if you remember, first of all, I'll take you back to the different companies, to the first lecture when we started off. If you remember, what were the different companies that we discussed at that point in time? See, domestic company. In the domestic company, what is a domestic company? It is defined under 222A, Indian company, and the company which has made the arrangements for the declaration of the dividend. Which is a domestic company, or who is a domestic company? Domestic company is defined under 222A to mean that it's an Indian company. Indian company is again defined under 226, which means company incorporated as per the Companies Act 2013. And a company which has made the arrangements for declaration of dividend in India. That is the meaning of domestic company. Then we have the foreign company. Foreign company is the one which is not a domestic company, which is defined under 223A. Then we had also seen what is the widely held and the closely held company. So widely held company was the government owned or RBI owned company, Nidhi company, listed company, subsidiary of the listed company. Closely held company is a private company or unlisted public company, which is not a subsidiary of listed company. Widely held is defined under 218, right? And company itself was defined under section 217, right? So these are the type of companies that we have under the Income Tax Act. So for the purpose of the taxability or the tax rates, we have to remember two types of company. For the purpose of provision, we can of course have the companies which is widely held, closely held, because there are some provisions which are applicable only to a closely held company, right? But for the purpose of taxability, even under section 217, company means an Indian company as well as a company which is incorporated outside India, right? Now, two companies are very important, domestic and the foreign company. And for this purpose, the tax rates vary between them. Okay. Now, what are the tax rates for the domestic company and the foreign company? That's what we are going to understand. And what are the different tax rates which are applicable for the domestic company, for the foreign company? That's what we are going to see first of all. Okay. So let's get started here. So, company under 217, domestic company and the foreign company. We are also going to look at what is the surcharges for these different companies. Okay. So for the foreign company first, which is the most easiest one, which I'm first going to talk about. What is the tax rate which is there? We have discussed it, but we are just revising for the purpose of, consolidating everything. What is the tax rate? You have to tell me very quickly. What is the tax rate of the foreign company? What is the tax rate? Very quickly. What is the tax rate? I'm just writing it over here. What is the tax rate here? 40%. Tax rate for the foreign company is 40%. Right? So the tax rate for the foreign company is 40%. Now, what is the surcharge for the foreign company? Foreign company is a company which is not a domestic company, right? So what is the surcharge for the foreign company? Surcharge for the foreign company is, or let me put it this way, so that, it's easier for you to jot down also. Okay, so what is the tax rate? 40%. The surcharge for the foreign company. What is the surcharge? Yes, very quickly. So if the total income exceeds 1 CR, income is greater than rupees 1 CR, but less than or equal to rupees 10 CR, then the surcharge is 2%. If the income is greater than rupees 10 CR, then the surcharge is 5%. So in the case of the foreign company, the surcharge is 2% or 5%. Correct? So that's very clear for the domestic company, foreign company, right? Yes, Kaushiki, you are correct. Kaushiki, the tax rate for the foreign company is 40% and not 30%. Yes, Viraj, Vinay, correct. Viraj, the surcharge is not 7% for the foreign company, it's 2 and 5%. Clear? 7% is for the domestic company. Okay. Now, what about the domestic company? As I said, the domestic company is defined as the Indian company, which is there. Indian company is the company incorporated as per the Companies Act, right? And then a company, domestic company, is an Indian company and a company which has made the arrangements for the declaration and payment of dividends within India. So any other company other than the Indian company which in respect of its income liable to tax has made the prescribed arrangements for the declaration of the dividend. Right now, which is the company which has made the prescribed arrangements for declaration and payment of dividend? That is provided under Rule 27. So the arrangements to be made by a company for declaration and payment of dividend includes that they maintain the share register for all the shareholders at the principal place of business within India. The general meeting for the passing of the accounts and for declaring the dividends are held only at a place within India. The dividends declared are payable only within India to all the shareholders. So if a company is like that, which has the principal place here in India and which has maintained the share register for all the shareholders, which has declared the dividend by holding a general meeting in India, then that company will also be considered as the domestic company. Clear? So what is the tax rate now for the domestic company? Now the tax rate for the domestic company are different. First of all, for the domestic company, there are different tax rates. One is the normal rate and second is the optional rate. Now, on the normal rates also, we have two tax rates which are there. And what are the two tax rates which are there? So, in the case of a normal rate for the company, which is normally applicable, right? For that purpose, there is the tax rate of 25% if the turnover or the gross receipts. If the turnover or the gross receipts of the company does not exceed rupees 400 crores. If the turnover or the gross receipts does not exceed rupees 400 crores for the previous year 1920, for the previous year is less than rupees 400 crores. Sorry, 4 crores, not 400, sorry, 4 crores. Then in that particular case, the tax rate is 25%. One second, I'll put it in the next line. Okay. So 25% is the tax rate, which is normally applicable if the company is a small company, the turnover of which does not exceed rupees 400 crores. Then in that particular case, the company can exercise 25% rate. It's a normal rate which is applicable, 400 crores and not, sorry, 4 crore, my mistake. Yeah. So 25% where the turnover or gross receipt in the previous year 1920 does not exceed 400 crores. Otherwise, it is 30%. So if it's a small company, then 25%, otherwise it is 30%. Clear? Now, in case of optional scheme, the company can exercise these optional schemes by opting in specifically for these kind of schemes. So these schemes are not mandatory. The default scheme which is there is 25% or 30%. But in case the company wants to opt in for the specific scheme, which is at the option of the company, so then in that case, the company can opt in for that particular scheme. Okay. So what are the tax rates in the optional scheme? There are two optional schemes which are there. One is under 115BAA and second one is in 115BAB. There are two optional schemes which are there. 115BAA and 115BAB. So two schemes we are going to look at it. Make it long little. Section 115BAA and section 115BAB. These are the optional weights which are there. Now, these are not mandatory. Only if the company would want to opt in for this, they could opt in for this particular scheme. Other than that, it is 400 crore if the turnover is less than 400 crores. In previous year, okay, this should be 2021. This should be 2021. If the turnover is less than 400 crores of the previous year 2021, then it will be 25%, else it is 30%. This is by default. In case you want to go for optional scheme, you could go for the optional scheme as well. Okay. Now, what is the optional scheme providing? 115BAA and 115BAB. What are these schemes? Let's try and understand. Now, 115BAA, the tax rate is 22%. The tax rate under 115BAA is 22%. Now, this is a conditional scheme. If you go for this particular tax rate of 22%, then there is a condition attached to it. So what is the condition here? The condition here is that if you fulfill certain conditions, the conditions of foregoing all the exemptions and the deductions, then only we will allow you the lower rate. Either you claim all the deductions and go with a higher rate, or you claim the lower tax rate and forgo all the deductions. That is the main criteria for opting in for the lower tax rate. And what are the conditions attached to it? So the total income of such a company will be computed without claiming the deduction under section 10AA, which is for the SEZ units, right, for the export. Additional depreciation, you cannot claim the additional depreciation under section 32(1)(2)(a). Obviously, you can claim the depreciation. There is no problem in claiming the depreciation, but you cannot claim the additional depreciation. Right? You cannot claim the additional depreciation. Then deduction under section 35, which is for the scientific research. Deduction under section 33AB, tea, coffee, rubber development account, right? For the site restoration fund under 33ABA, you cannot claim that. 35AD, investment allowance, you cannot claim that. So deduction under section 33AB, 33ABA, 35AD. All of these deductions you cannot claim. You cannot claim this, right? So 22% is the available tax rate, but you would not claim deduction under 10AA, 32(1)(2)(a), additional depreciation, 33AB, 33ABA, scientific research expense, investment allowances under 35AD, 35 CC or CCD, and you will not be able to claim any deduction under Chapter 6A as well, which is the profit-linked deductions, which are usually claimed under ATIA, ATIB, all of these, ATIAC, all these deductions you would not be able to claim. Other than two deductions. Or let me write it like this. What you can claim is, one can claim depreciation, and secondly, ATJJAA for the employees and ATM. You can claim these two deductions, ATJJAA and ATM, right? So you could claim ATJJAA, ATM, and you can claim the depreciation. Clear? So these two deductions you can claim, and the other deductions would not be allowed to you. Now, once you claim this option, you will have to exercise this option. You will have to be exercised for this particular option in the very first year. You will have to specifically exercise this option on or before the due date of filing the return of income under 139(1). And once you exercise this option, it will apply to all the subsequent years as well. It will be applied to all the subsequent year, and once the option has been exercised, it cannot be withdrawn for the same or any other previous year. So, exercise the option before the due date of ROI under section 139(1). Once option exercised, it cannot be withdrawn. So once the option is exercised, it cannot be later on withdrawn. Are we clear? So this is the optional scheme under 115BAA, which is 22%, plus here the surcharge is applicable of 10%. And the cess is 4%. Here the surcharge is without any income limit. It's flat 10%. It's flat 10%. Okay. So you will have to exercise this option before the due date of filing return of income. Once the company exercises such option, it would continue to be governed by this particular provision and cannot opt for regular provision. You cannot say that in this year, I'll go with 115BAA. In next year, I'll go with the normal 25% tax rate. No, that's not possible. Further, this particular scheme, MAT will not be applicable. MAT will not be applicable here. Okay. What is the surcharge in these two cases? What is the surcharge in these two cases here? So here the surcharge which is there is, if the income exceeds 1 CR but is less than 10 CR, then in that particular case, the surcharge for the domestic company is 7%. If the income exceeds 10 CR, then it is 12%. Clear? Then it is 12%. But here under 115BAA, the surcharge is 10% at the flat rate. And therefore, it makes the effective tax rate of 25.1%. 168%. This is the effective tax rate. Okay. Next is 115 BAB. Next is 115 BAB. Now, what does 115 BAB provides? This particular section provides for the lower tax rate of 15%. This particular provision provides for the lower tax rate of 15%. Plus, again here, the surcharge is there. Now, what is the surcharge which is provided here? Again, it's a flat rate of 10%. Plus 10% plus 4% cess, which makes it to effective tax rate of 17.16%. Now, to which companies this 115 BAB is applicable? It is applicable to a domestic company where it includes the income which has been derived from the manufacturing, a domestic company which is engaged in the manufacturing business. The company is set up on or after 1st October 2019. So, company set up on or after 1st October 2019. It should commence the manufacturing business. It should commence the manufacturing business on or before 31st March 2024. Now here, what do we understand by the manufacturing? What do we understand by the manufacturing? So manufacturing here does not include development of computer software, mining, conversion of marble blocks. I'll just write it over here. Manufacturing does not include these businesses. And what are these businesses? Development of computer software, mining, conversion of marble blocks or items into slabs, bottling of gas into cylinder, production, printing of books or production of cinematographic films. So that is not covered within the manufacturing. But what is covered in the manufacturing is also the electricity generating company. So here not only the manufacturing company plus the electricity generation company are also covered. Right? Electricity generating companies are also covered. So this option is available for the new manufacturing or electricity generating companies. Again, this is a condition-based exemption. So for the condition-based exemption, as I said, here you will have to forgo certain deductions. And what are the deductions? Also here, there are additional conditions to it. Company should not be formed by splitting up or reconstruction of existing business, right? Second-hand plant and machinery should not be used. Now your second-hand plant and machinery excludes imported second-hand machinery and where the value of the second-hand plant and machinery is less than 20%. Is less than 20% of the total value of plant and machinery. Right? Company should not be engaged in business other than that of the manufacturing. So these are the conditions which are attached to it. So the company is not formed by splitting up or reconstruction of the business already in existence. It does not use any second-hand machinery other than which is the imported machinery, and where the value of the machinery does not exceed 20% of the total plant and machinery. The company is not engaged in any other business other than manufacturing. Are we clear? Now here, how will the total income be computed? As I said, the total income computation will remain the same even in this particular case as it was for 115BEE. So the total income computation will remain the same here. Total income without claiming the deduction under section 10AA, additional depreciation, 33AB ABA for the site restoration, tea, coffee, rubber development, 35 for scientific expenditure, investment allowance under 35 AD, chapter 6A other than 80JJ AA or ATM. You could of course claim the depreciation. You could of course claim the depreciation here as well. Are we clear? So this is how it is a conditional based tax rate, which is there for the specific company which is engaged into the manufacturing. Are we clear? In case the company has any income which is not derived from production, then for that particular income, 22% rate will be applicable. That income will be taxed at 22% rate. So you can write it over here. Income not derived from manufacturing or not incidental to manufacturing, 22% tax rate on gross basis. That is without allowing any expense or deduction. Income chargeable at specific rates at those rates. For example, 111A, 112A, 112, 115, BBF. If there are specific rates which are prescribed, then those specific rates will only be applicable. Here, this particular 115BAB, here it also provides that there could be the implication that there is a close connection between a person who is opting in for 115 BAB and any other person, and the business is arranged between both of them, that the profits are artificially shifted over here in order to claim this lower tax rate, then the AO has the power in this section to recompute the profits as may be reasonably deemed to have been derived from this particular manufacturing business. So it is possible that I may shift the profits here instead of the other business so that I could claim the lower tax rate over here. So in that particular case, the AO has the power to deem the profits which are reasonably here attributed to this manufacturing operation. Because otherwise, I may just try to shift the profits over here. And for 115 BAB, the specified 115 BAB transactions between the closely related enterprises or associated enterprises, what we are going to learn in the transfer pricing chapter, this will be covered as the specified domestic transaction to which the transfer pricing will also become applicable. To which the transfer pricing will also become applicable. So here, you can write down transaction between A's or closely related enterprises under 115 BAB or closely related enterprises. So A's, what is the meaning of A? You are going to learn in the transfer pricing chapter. Right? If there's a close connection between the person, then this will be a specified domestic transaction covered under transfer pricing regulations. Right? Also, one more additional thing over here. As I said, in case the income of the person is attributed here by AO, right? If it's a specified domestic transaction, the amount of the profits will be determined having regard to arm's length price. So here then, ALP would be applicable. What is ALP? What is specified domestic transaction? You will learn it in the transfer pricing chapter. And here, to this income, 30% tax rate will be applicable. Are we clear? 30% tax rate will be applicable. Any doubt? Further, short-term capital gains from non-depreciable assets other than 111A will be taxed here at 22%. Will be taxed here at 22%. Okay. In case the assessee fails to comply with this particular conditions at any point in time, then the option will be invalid. Then the normal provisions will be applicable. Again, here, the assessee has to exercise the option on or before the due date of 139(1) for furnishing the return of income for the first year. For the first year when it is incorporated. For the very first year in which it commences its business. Not incorporated, but when it commences its manufacturing business. And such option, once exercised, shall apply to all the assessment years. And once the option has been exercised, it cannot be withdrawn. So you can write down option has to be exercised before the first returns as per the due date of ROI under section 139(1). Once option exercised, it cannot be withdrawn. Are we clear? It cannot be withdrawn. Any questions so far? Yes, Jacob, I'll make the foreign companies little visible for you. Are you able to see this? For turnover calculation, whether income from other sources, income can be included. For turnover calculation, so what turnover means? The turnover of the business, right? And income from other sources will not fall under the turnover. Jacob, we did surcharge for the domestic company, right? Yes, Raja, you can claim the depreciation. You cannot claim 35 AD. Vinay Kumar, no specific reason they would want to incentivize certain manufacturing businesses and maybe not them. So these have been excluded, or these are maybe not considered as manufacturing in a way, because development of computer software is not technically manufacturing. Mining is not technically manufacturing. So therefore, they have been put outside the purview of this. Or printing of books does not fit within the definition of manufacturing. Surcharge, Jacob, for the foreign companies, I'm not able to make it bigger. So it's, if the income exceeds 1 CR, less than 10 CR, it's 2%. If the income is more than 10 CR, it's 5%. Okay. Okay. Any other questions? Perfect. So this is 115 BAA, 115 BAB. Clear? And in case they are not going for the optional scheme, in case they are not able to forgo these deductions, then they could go for the normal scheme. Normal rate is 25% where the turnover of 2021 is less than 400 CR, and 30% in other cases. And the surcharge is 7 and 12%. Okay. Now, each year, not each year, in fact, in the first year, when the company wants to exercise this option, they will have to compare the normal rates with the optional rates. And whatever is beneficial, that will be applicable. So for the examination perspective, a question could come up where you will have to compare the normal rate by claiming all the deductions and exemption, what is the tax which you have to pay, and the optional rate, if you forgo the deduction and claim the lower rate, what will be the amount of the tax, and whichever will be beneficial will be applicable in your case. Okay. Again, here also for 115 BAB also you can write down MAT is not applicable. MAT is not applicable. Okay. Clear? Then we had seen what are the closely held and widely held company. As I said, widely held was something which is company owned by RBI, government, listed company, subsidiary of a listed company, private company and unlisted company are closely held company. And this is particularly relevant as there are certain provisions which are only applicable to the closely held company. Maybe you can write down those provisions. Provision applicable to closely held company. By now, you should have remembered this because we have done this. 222E, 56 to 7B, issue of shares greater than the face value. The consideration in excess of fair market value is taxable. Section 68, sum received by a closely held company as share application money, share premium, and the explanation is not satisfactory. 79, carry forward of lossless if there is change in the shareholding. 179, which is liability of directors of private company in liquidation. Okay. Clear? Any doubt? Okay. Any questions, any doubt? Okay. Now we'll solve one small question over here so that you get the hang of how do we apply the provisions in case where you have the option as well as the normal provision to be selected. But last one thing before we go towards the question in this particular section is, as I said, on failure to satisfy the conditions, the option exercise would become invalid and the normal provisions will become applicable. In case of 115BAB, if the option becomes invalid because the conditions are violated or the conditions are not satisfied, then the person can still opt for 115BAA. So if 15% becomes invalid, you can still go for 115BAA, which is 22% rate. Clear? Which is 22% rate. Right? Also, MAT credit under 115BAA cannot be brought forward. Any brought forward MAT credit will not be allowed. So if you have any MAT credit, you will have to first exhaust the MAT credit and then only go for 115BAA. Otherwise, it will not be allowed. Under 115BAB, it's any which ways a new company, so there is no question of any MAT credit. Clear? So here, also you can write it down here. 30% tax rate, which is there for SDT, plus add here 10% surcharge and 4% cess. There will be 10% surcharge and 4% cess. Okay. Here also 22%, which is there, plus 10% and 4% surcharge and cess. Here also STCG 22% plus 10% and 4%. Clear? So I'll give you the question and then we'll take a break so that, if you want to solve the question during the break, you could. So just write it down, the question. ABC Private Limited incorporated on 1/11/2022 is engaged in manufacturing of footwear and has set up factory in Northeast. It has reported the net profit of rupees 80 lakhs for the previous year, 22-23. The following items have been credited or debited to P&L. Contribution to research association eligible for deduction under section 35(1)(2) of rupees 2 lakhs. Expenditure towards in-house R&D of rupees 2 lakh. Depreciation as per books of accounts. Rupees 40 lakhs. Royalty received from patents developed and registered in India rupees 10 lakhs. Expenditure on royalty rupees 1 lakh. STCG on transfer of listed equity shares on a recognized stock exchange rupees 10 lakh. Other information. Asset acquired and installed or put to use. Asset acquired and installed or put to use during the previous year. Plant and machinery rupees 1 crore. Rupees 20 lakh paid in cash. Building rupees 50 lakh. The company has employed new employees to whom salary paid was debited to P&L. Details of which are here under. Date of employment, one 11/21 or 1/11/22, 1/12/22, 1/1/22, 1/2/22. Number of employees 2, 4, 1 and 25. Salary per month 18,000 in cash per month and per employee. 18,000, 25,000 as ECS, 28,000 in check, 11,000 in cash. So you're required to compute the total income and the tax. Jacob, how AMT credit would be here? Because AMT is applicable for individuals and the other entities. This is for the companies. So no AMT credit. Okay. So I'm taking a break of 10 minutes. Till then, if you want, you can solve the question or you can solve it after break. But I've written the question already. So let's take a break of 10 minutes and then we get back. Yeah. Yes, students, did you solve this question? Shall we solve together? Okay. So we'll start with the net profit of rupees 80 lakh. Now tell me the adjustment one by one. Contribution to the research association eligible for deduction under section 35(1)(2) of rupees 2 lakhs. What would you do? We are computing first the normal income. First, I am computing the normal income as per the normal tax rate. Contribution to the research association eligible for deduction under 35(1)(2). Let's see, Vinay Kumar, let's solve together. What would be the effect of this adjustment? Why add back? I'm computing as per the normal provisions. Why do we add back? This will be allowed. No adjustment here. 35(1)(2), no adjustment required because this is allowed as the deduction. Okay, so if it is debited to the P&L, why do we add back? There will be no adjustment. Similarly, expenses towards in-house R&D of rupees 2 lakh will be allowed. So here no adjustment. Depreciation as per books of account, add back. Okay. Depreciation as per books of accounts, add depreciation as per the books. Which is 40 lakhs. Okay. Next is royalty received from patents developed and registered in India rupees 10 lakhs. Expenditure on royalty rupees 1 lakh. What will be the effect here? No treatment. No Vinay. What will be the effect over here? Anyone? So, royalty from the patents registered and developed in India is taxable at a special rate under section 115 BBF. So this is specifically taxable under section 115 BBF at the rate of 10% without allowing any deduction of expenditure. So therefore, since it is taxed at a specific rate, I would exclude it here and would add back the expenditure. Less royalty taxed under section 115 BBF. So this is not going to be taxed under the normal rates. This is specific tax rate which is provided, 10 lakh, and expenditure add back expense on royalty, which is 1 lakh. Next is STCG on transfer of listed equity shares on recognized stock exchange. No, Vinay, we have not done 115 BBF till now. Hence, I mentioned it very clearly that this is taxed at 10%. Less. Yes, Vinay, correct. So, STCG would be reduced because this is also taxed at specific rate or special rate. Okay. So, less STCG. Less STCG, which is how much? 10 lakhs. I'll separately here include royalty income since no expenditure is allowed, so this will be taxed at 10 lakh. Under the head capital gain, STCG will be 10 lakhs. Okay. Next is other information. Asset acquired and installed or put to use during the year. Plant and machinery 1 CR. 20 lakh paid in cash and building 50 lakh. This is for the purpose of depreciation. So depreciation as per Income Tax Act. Plant and machinery and building. Cost is how much? 1 CR and 50 lakh. What is the depreciation? Quickly tell me first for the plant and machinery. Yes, Kaushiki, it's 15%, but what is the depreciation amount? Yes, Kaushiki, you would reduce the cash amount from the plant and machinery. We would reduce the cash expenditure because that is not considered in the actual cost. So 20 lakhs would be reduced from 1 CR. So less cash purchase in excess of 20,000. This would be 80 lakh and this is 50 lakh. Okay. Okay. Now, what is the depreciation? Give me the final amounts of depreciation. Yes, this is 10% building and 15% plant and machinery. So, what is the depreciation? Kaushiki, it's not 12 lakhs for plant and machinery. It's not 12 lakhs. How you guys are getting 12 lakhs? So it is 80 lakhs into 15%. Into 15%. Yes, sorry, it's 12 lakh only, my mistake. Yeah. So plant and machinery depreciation is 12 lakhs. Depreciation 12 lakhs and this is 5 lakhs. Right? Now, are you missing out something else as well? Yes, Jacob, correct. So, additional depreciation will also be allowed on the plant and machinery. So, Jacob, yes, very perfectly you pointed out that there would also be the additional depreciation. So therefore, in that particular case, the additional depreciation will be 20% because the assessee is engaged in the manufacturing. Yes, Vinay, very good. Kaushiki, yes, additional depreciation. What is the amount of additional depreciation? What is the additional depreciation for the plant and machinery? Yes, Jacob, 16 lakh, which is correct. So additional depreciation at the rate of 20% is 16 lakh. So my total depreciation will be how much? 28 lakhs plus 5 lakh, which will be how much? 33 lakhs. So this is what will be allowed to me less depreciation as per IT Act. 33 lakh. Okay. So now what is the profit that I'm getting here? 35%. Vinay, what is 35%? What is the profit that I'm getting over here? Let's calculate. $80 plus 41 lakhs minus 20 lakhs minus 33 lakh. The profit is 68 lakhs. Are you getting 68 lakhs? Is everyone getting 68 lakhs as the profit? Yes or no? And what is my total income? I'm getting 88 lakhs as the total income. How much you're getting? Yes, correct, Vinay, 68. Okay. So total income is this much. Then there is other information which is also available. Here, what they have said is that date of employment, there are new employees and the salary was debited to P&L. Date of employment, number of employees and salary per month and per employee. So what would be the deduction under section 80JJAA? Will there be any deduction under section 80JJAA? Yes. What will be the deduction under 80JJ? Why Vinay no deduction? Why Kaushiki? Yes, the conditions are not satisfied in this case. In the first case, it is less than 150 days because here it is engaged in the manufacturing of footwear. So 240-day condition will not be applicable, but 150-day condition will be there. And also this is paid in cash. The emoluments are paid in cash, so this will not be covered. Here it is from December and here 25,000 is paid through ECS. So what was the condition which was there for 80JJAA? The condition which was there for 80JJAA is, let's go back and see. 1 second, let me bring it down. Yes. So what was the condition? The salary of the additional employee excludes salary greater than 25,000 per month. If the salary is more than 25,000 per month, then in that particular case, the deduction will not be available. Now, this employee which is there, this particular second set of employees, 4 employees are hired in December 22. Now, from December to March, how many days it comes? How many days? This is also 121 days. So therefore, 150-day condition is not satisfied. Even in this particular case, this is more than 25,000. So therefore, not applicable. And the last days, again, it is in cash. So therefore, and plus the days are not satisfied. So no deduction under 80JJAA. Are we clear? In case, if I would have said, let's say, this instead of check of 28,000, if this would have been in cash, 28,000. Then there would also have been disallowance of expense as well. There would have been disallowance of expense because this salary is debited to P&L account. Clear? So therefore, in this case, no deduction under 80JJAA is available. My total income is coming to 88 lakhs. Now, what will be my tax as per the normal provisions? What is the tax as per normal provision? So, tax at the rate of 30%. We do not know the turnover, so I'm not going for 25% tax rate. So, first on the income of 68 lakhs, 30% will be applicable. So, what is the tax coming to? 68 lakhs into 30%, 20.4 lakhs. On royalty at the rate of 10% under section 115 BBF, it is 1 lakh, right? STCG under section 111A at the rate of 15%. How much does it come to? 15 lakhs, all right? So in this particular case, my total income comes to, the tax liability comes to 20.4 plus 1 lakh plus 15 lakhs. Sorry, 1.5 lakhs, right? 22.9 lakhs. This is 1.5 lakh. This is 22.9 lakhs. Any surcharge which is applicable over here? Any surcharge? Yes, Vinay, correct. There would not be any surcharge because the income is less than 1 CR. If it would have been more than 1 CR, then there would have been surcharge of 7%. Plus, add the cess. Do not forget the cess. Plus cess at the rate of 4%, which comes to 23.82 lakh. This is as per the normal provisions, right? Now we will also calculate as per the provision of 115 BAB because this is a manufacturing entity, right? So let's calculate computation of tax as per section 115 BAB. Are we clear? 115 BAB. So net profit, again, how much it is? 80 lakhs. Now tell me about contribution to research association eligible for deduction under section 35. What will be the effect here? What will be the effect over here? Yes. Very quickly. Add it back. Yes, not eligible, 4 lakh, add back. That's correct. So you will add back the 2 lakh contribution to research association and expenses towards in-house R&D. Kaushiki, Vinay, Jacob, yes, it's correct. So add back contribution to research association 2 lakh, add contribution to in-house R&D 2 lakh. Add back depreciation as per books of accounts. How much was the depreciation as per books of accounts? 33 lakhs, sorry, 40 lakhs, right? Add back expense on royalty. This will remain the same. How much is the expense on royalty? 1 lakh. Less royalty income, this will remain the same, 10 lakh. Less STCG, this will also remain the same, 10 lakh. Less depreciation as per IT Act. What will be the depreciation as per IT Act? 33 lakhs. Should I take 33 lakhs over here? Jacob, I didn't get your question. What should be added back to profit? Kaushiki, 33 lakhs? No, not 33 lakhs. So, Kaushiki, in your notebook, write it down 33 lakh and make a big cross mark, because this will help you remembering in the exam that you do not have to take the additional depreciation for the purpose of 115 BAB. Put it like this only in your notebook with the red pen, because when you are revising for your exam, you would recollect this particular point. So that's why we need to solve more and more questions. So this will be 17 lakhs and not 33 lakhs. Clear, Kaushiki? Yes, Vinay, Jacob, correct. Okay. So what would be my total income now? Calculate the total income for me. 80 lakhs plus 4 lakh plus 40 lakhs plus 1 lakh minus 20 lakhs. Minus 17 lakh. It comes to 88 lakhs. Yes, contribution to scientific research in-house R&D should be added back. Yes, Jacob. Because if you remember, what did I say for 115 BAB? You do not have to consider the scientific research expenses. Okay. So 88 lakhs. I think we got 88 lakhs here also. Okay. So the total income is coming same in both the situations. Right. Now, what will be my tax here? Tax under section 115 BAB will be how much? Tax under 115 BAB will be on this amount, excluding the 88 lakhs minus, or sorry, out of 88 lakhs, this 20 lakhs, I will have to remove it. Okay. Sorry, total income is not 88 lakhs. You have made a mistake and I have too made a mistake. This is my PGBP. And we need to here consider royalty income. You forgot that, right? 10 lakhs, and my STCG under the head capital gain will be 10 lakh. So my total income comes to how much? 108 lakhs. So on 88 lakhs, my tax will be at the rate of 15%. Tax will be at the rate of 15%, right? Which comes to how much? 13.2 lakhs. Then royalty income under section 115 BBF at the rate of 10%, which comes to 1 lakh, right? Which comes to 1 lakh. Then I will have royalty income, STCG under section 111A at the rate of 15%, 1.5 lakh. So here my total income is, so tax is coming to 13.2 plus 1 plus 1.5, 15.7 lakhs, right? Surcharge will be levied here at the rate of 10%, 17.27 lakhs. Cess at the rate of 4%, 17.96 lakh is the tax. Are you getting this? Are we getting this answer? Yes or no? Are you getting the same answer? Yes. Perfect, Jacob. So 17.96 lakh versus how much was my tax under the normal provision? 23.82 lakh. Under the normal provision, I was getting tax of 23.82 lakh. Here, I am getting the tax of 17.96 lakh. So obviously, it is beneficial for the assessee to opt in for the normal, the 115 BAB. So opt in for 115 BAB. Since this is the first year, it can exercise this option. Surcharge on total Vinay. Surcharge is on total amount. Okay. Any questions? Any doubt? Any questions? Any doubt? Yes. No, Vinay, loyalty expenditure will nowhere be allowed. Surcharge on total. Yes, Jacob. Once you opt in for 115 BAB, you will have to bear the surcharge. Clear? Any other question? Yes, surcharge will be on total. Okay. Yes. So let's proceed further then. Okay. Now the last part. Jacob, if 80JJAA deduction was available, there could have been difference. Maybe the tax under normal provisions would have been lesser. And even that 80JJAA would have been also available for 115 BAB also. 80JJAA is available for both any which ways. Kaushiki, no. You cannot opt in the later year 115 BAB 115 BAB, you cannot opt in later year. 115 BAA, yes, you can opt in the later year also. But once exercised, you cannot withdraw. Okay. Shall we move ahead? Okay. Now, moving towards the another important part for the companies is the minimum alternate tax, MAT provision. Okay. Now, minimum alternate tax, which is there. Remember this, if a question comes like what we solved just now, it is possible that normal income tax rate may be lower than the 115 BAA or BAB rate. In that case, do not forget in exam, write this down in your notebook. Do not forget in exam to also compare MAT with the normal provision in case you are opting in for normal provisions. Do not forget MAT calculations for a company unless the exam question specifically asks you to ignore MAT. MAT will not be applicable for 115 BAA or BAB. But if you're going under normal provisions, then you also need to consider the minimum alternate taxes. Do not forget, write it in the bold words in your notebook. Clear? Now, MAT is applicable in case of both domestic or the foreign company. If the income tax on the total income as per the normal provision is less than 15% of the book profits, then MAT is applicable. So, it is applicable to both domestic plus foreign company. If tax as per normal provisions is less than 15% of tax on book profits, then you need to compute the tax as per the MAT, because such book profits then will be deemed to be the total income of the assessee. And the tax will be, MAT is at the rate of 15% on book profits. Here, remember one thing, surcharge and cess are applicable. So surcharge is same 7% and 12%. And for foreign company, it is 2% and 5%. Clear? So surcharge and cess will also apply over here. Are we clear? Any doubt? Any questions? Clear? Okay. Now, how do you compute the book profit? So explanation 1 to 115 JB provides for the book profits. There are certain adjustments which are required to be made in order to compute the book profit. The book profit is net profit as per the P&L account prepared in accordance with the Companies Act Schedule 3. Schedule 3 of Companies Act 2013. And add or less certain adjustments to it. So, first adjustment, what we are going to see is add amount transferred to the reserves. Add amount transferred to the reserves. So any amount which is transferred to the reserves will be added back, including the amount transferred to the revaluation reserve. So amount standing in the revaluation reserve, the profit will be increased by the amount transferred to the revaluation reserve. That amount will be added back. So any reserves including the revaluation reserve. Clear? Now understand here one thing, that here the amount will be added back if the amount has been transferred to the revaluation reserve on the retirement or disposal of the asset if the same is not credited to the P&L account. So you will add amount in the revaluation reserve on actual retirement or disposal of asset if not credited to P&L account. Are we clear? If not credited to the P&L account. Then the next adjustment is less any amount withdrawn from the reserve. Any amount withdrawn from the reserve is to be reduced. Less amount withdrawn from the reserve. So amount withdrawn from any reserve, if such amount is credited to the P&L, that is to be reduced. So if you are transferring any amount to any reserves, that has to be added back because you would have debited to P&L, so you will have to add back. But if there is amount in the revaluation reserve, which is on account of retirement or the disposal of the asset, which is the actual profit. So you have to only consider the realized profit or losses and not the revalued profit or the notional profit or losses. So the notional profit or losses you will have to add back. Actual profit you will have to consider it. So notional losses, if you have any amount transferred to reserve, if you have debited to P&L, you will add back. You will add any amount which is realized on the disposal of the asset, which is in the revaluation account. If it is not credited to the P&L account, you will add back that. And you will less any amount withdrawn from the reserve if it is credited to the P&L account. Clear? Next is depreciation. So this is first. Second is depreciation. Now for the depreciation, you would add the depreciation back. You would add the depreciation back. The amount of depreciation will be added back. Add depreciation. However, you will less the depreciation again, excluding the depreciation on revaluation of assets. Depreciation on revaluation of assets. So what in actually you are doing is you are adding back the depreciation on the revaluation of assets. Because first you are adding back the depreciation, then you are reducing the depreciation but excluding the depreciation on the revaluation of assets. Here you do not need to reduce the depreciation as per Income Tax Act. No. Here the same depreciation which is debited to your P&L account, you have to add back first. Because it may include the depreciation on the revaluation of assets. You have to again reduce the same depreciation as per the books of accounts only, excluding the depreciation on the revaluation of assets. Are we clear? Secondly, you will have to also reduce the revaluation reserve withdrawal which we have already considered here, the withdrawal from the revaluation reserve, which is credited to the profit and loss account, to the extent it does not exceed the amount of depreciation on revaluation of assets. So the amount withdrawn from the revaluation reserve, amount withdrawn from revaluation reserve to the extent credited to the P&L, credited to P&L, to the extent it does not exceed the depreciation on revaluation of assets, restricted to depreciation on revaluation of assets. Are we clear? Okay. So this is for the depreciation. The third one is the deferred tax asset and liability. Deferred tax asset is to be added, is to be reduced, and deferred tax liability is to be added back. So add deferred tax liability less deferred tax asset. Okay. So less deferred tax liability, add deferred tax liability less deferred tax asset. Clear? The next one which is there is notional loss, on the transfer of units of business trust. Notional loss on units of business trust. Notional loss on business units of the business trust has to be added back because it's a notional loss. So on transfer of a capital asset, which is a share of the special purpose vehicle to a business trust in exchange of units allotted by that trust. We are going to see that when we are going to go into the REIT provision. That time again, I refer back this provision. So if the shareholder or the unit holder transfers the share of a special purpose vehicle in exchange of the units allotted by the trust, the notional loss which is there has to be added back. Are we clear? And the actual loss is to be reduced. So this you have to add, and actual loss you have to less. The actual loss you have to add on transfer of units of business trust. Less notional gain on units of business trust and add actual gain on transfer of units of business trust. Are we clear? Next is the expenses on the income exempt under section 10, 11 and 12. So expenditure which is relating to the exempt income under section 10 or section 11 or section 12 is to be reduced, and exempt income is to be added back. So less expenditure on exempt income under section 10, 11, 12, add income exempt under section 10, 11, 12. On that, the MAT will not be applicable. Next is income from the AOP BOI. So less the income which is the share in the AOP or BOI is to be reduced, and you will add back the expense relating to the same. Okay, so less the income being share of assessee from AOP BOI, on which no tax is payable under section 86. We are going to see this again while we do AOP BOI. Add back expense on income being share of the assessee on which tax is payable, no tax is payable under section 86. Okay. Less royalty income from patents chargeable under section 115 BBF. Add expense on royalty income. So in case in the last question what we solved, if we would have gone as per the normal provisions, then we would have also compared the MAT liability with the normal provision to see that if it is less than 15% of the book profit. Now, while calculating the book profit in the last question, if we would have considered MAT there, we would have reduced the royalty income and add back the royalty expense, because MAT is not applicable on the royalty income and expense. Are we clear? Then next is you have to add back the provisions, for the unascertained liability. Provisions for unascertained liability. So provisions for the ascertained liabilities are allowed, but unascertained liability will not be allowed. Okay. Provision for the losses of the subsidiary company. Provision for losses of subsidiary company. Income tax payable. Income tax payable will also be added back. Now, income tax, whether it will include the interest component and the penalty component. So income tax paid or payable will include the buyback tax, dividend tax, interest, surcharge, and cess. Will not include the penalty. So income tax will have to be added back. Are we clear? So income tax will include the interest, surcharge, cess, all of this. Okay. Then dividends. Dividends have also to be added back. So dividends which are paid or proposed will have to be added back. Dividend paid or proposed. Clear? And the last one, provision for diminution in the value of asset. I'll write it over here only. Provision for diminution in value of asset has to be added back. Okay. So these are all the items which are to be added back. Okay. Now, what you have to reduce is less. You need to reduce the income from the tonnage tax scheme or profit from the tonnage tax scheme. We will see this. This is for the ship companies which is there. So this is the tonnage tax scheme which we are going to look when we are going to do this particular scheme for the shipping companies. Profits of the sick industrial company. Profits of sick industrial company. This you can write for shipping company. Tonnage tax scheme. So profits of the sick industrial company from the year in which the company becomes sick and ending with the year in which the entire net worth becomes equal to or exceeds the accumulated loss, meaning the net worth becomes negative. Till that year, you will exclude the profits of the sick company. Right? Then next, what you have to reduce is brought forward loss or unabsorbed depreciation. This is very important. Brought forward loss or unabsorbed depreciation, whichever is less. Whichever is less, you need to reduce it. So the aggregate amount of unabsorbed depreciation and brought forward loss, sorry, you will compare the brought forward loss or the unabsorbed depreciation, whichever is less, as per the books of accounts and not as per the Income Tax Act. So the brought forward loss excluding the depreciation, and you will have to compare the depreciation, unabsorbed depreciation, whichever is less will be allowed. If either of the figure is nil, then no deduction will be allowed because that will be considered as the lesser amount. If either brought forward loss or unabsorbed depreciation is nil, no deduction allowed. In case of a company which has gone into the insolvency proceedings, in case of the company which has gone into the insolvency proceedings, for that company, this condition has an exception. And what is that exception? So the exception to this is that in case of the companies which have gone into the insolvency proceedings, the aggregate of unabsorbed depreciation and brought forward loss will be allowed. So for companies undergoing IBC proceedings, aggregate of UAD plus brought forward loss is allowed. Clear? So aggregate of UAD plus brought forward loss will be allowed. Fine. Now the last one, you will also less the income of the foreign company. Income of the foreign company from the capital gain arising on transaction in securities or interest, dividend, royalty, FTS, which is chargeable at the specified rates under the specific section 115A. If such income is credited to the P&L account, then that will be not included because that income is taxed at rate lesser than 15%. Are we clear? So just write it down. less income of the foreign company, from capital gain arising on transaction in securities or interest, dividend, royalties, fees for technical services, chargeable at rates specified in chapter 12, that is under section 115A. If such income is credited to the P&L and the income tax is there in accordance with the provisions of the Act, including the rates as per the DTL, then 15% rate will not be applicable. Are we clear? So in case of foreign companies, the FTS, royalties, these are taxable at much lower rate. So the dividend received or the FTS which is received and the expenditure which is relating to that, then that particular will be added back, expenditure and the income will be reduced. Even if the rate under the DTL is there and it is not in accordance with the Act, there also if the rate is lesser than 15%, still that income will get reduced. Clear? Any doubt till now? So if the income is capital gain, interest, dividend, royalties, FTS, and if it is chargeable to tax as per the rates under chapter 12 or as per the DTL, if such income is lesser than, if such tax rate is lesser than 15% rate, then in that case, the income will be excluded. Okay. If tax on income lesser than 15%. Okay. Any doubt, any questions? 115DA is for every other company other than engaged in manufacturing. Yes. See, Jacob, very important question you have asked. What is the reason behind MAT? That's very, very important question. So why was MAT provision introduced was because the companies were avoiding the taxes by claiming huge deductions. And they were distributing the dividends also, but they were not paying any taxes. So they were distributing huge amount of dividends, but they were not paying any taxes. They were claiming losses because they were claiming expenses. They were claiming several deductions. So therefore, it was thought that the companies, in order to prevent their tax avoidance, MAT should be introduced for such companies. And therefore, the minimum alternate tax has been introduced. Are we clear? Kaushiki, add expenses, less income. Yes, that's correct. So less income exempt. Okay, I've written it reverse way. So you will add the income. Sorry, no, it's correct. You will add less the income exempt and add the expenses on exempt income. Yes. Correct, Kaushiki. Okay. Any other doubt? Okay. Now, book profit for the Ind AS compliant companies. For the Ind AS compliant companies, the book profit may be different from the normal company which are there because they have to comply with the Ind AS requirement, right? So again, we need to make certain adjustments which are specifically for such companies which are following the Ind AS. And what are these adjustments? Let's try and understand. Now, book profit, you can give the heading for the Ind AS compliant company. Book profit for Ind AS compliant companies. Now, what happens when there is the Ind AS applicability? As I said, the book profits are computed in a different manner. So the financial statements are drawn in compliance with the Ind AS, which is again specified in the Companies Act itself. So for these kind of company, the additional adjustments need to be done to the book profit. The normal adjustments will be done, but there will be the additional adjustments which also need to be done. So for these companies, if you see, there is the item called other comprehensive income, right? What is other comprehensive income? You all have been doing Ind AS, you know better than me. So tell me, what is other comprehensive income? What is other comprehensive income? Very quickly. Notional incomes, yes. So other comprehensive income includes the expenses, revenues, gains or losses that are not yet realized and therefore are excluded from the income statement. So OCI is the notional income or expenses, right? So this is not yet realized. And therefore, the notional income or expenses are recorded in the other comprehensive income. So for that purpose, we need to make certain adjustments in the book profit. So what are the adjustments which we need to make? Now, other comprehensive items or income may include certain items that will be never reclassified to the P&L. And they have the second category, that there will be the income or expenses which will be reclassified to the P&L. Now the OCI, which will be reclassified to the statement of P&L, that will not have to be adjusted because that any which ways will be reclassified to the P&L. We have to make the adjustment in the book profit for the other comprehensive income, the items that will permanently be recorded in other comprehensive income and will never be reclassified to the P&L. So for those, we need to make the adjustments. So OCI, items that will be not be reclassified to P&L. For items that will be reclassified to P&L, you do not need to make any adjustment. So you need to increase all the amounts credited to the OCI that will not be reclassified to P&L and decrease all the amounts debited to OCI that will not be reclassified to P&L. So add all amounts credited to OCI less all amounts debited to OCI, but the ones which will not be reclassified to the P&L. Clear? So here also, for certain items, you will not do any adjustment. So no add or less, or no adjustment for revaluation of the assets. Revaluation of the assets, you will not make any adjustment. no adjustment for the revaluation of the assets, and gain or losses from investment in equity instruments designated at the fair value through OCI. So no adjustment shall be made where the amount credited or debited to OCI under the head items that will not be reclassified to P&L is in respect of revaluation of assets or gain or losses from the investment in equity instruments which are designated at fair value through the OCI. This adjustment will be made only when the asset, unless the asset is retired, asset or investment is retired, disposed, released, or transferred. Okay. So the book profit of the previous year in which the asset investment is transferred, retired, disposed of shall be increased or decreased as per the actual amounts. Are we clear? So this is what the adjustment is. So OCI items that will be never be reclassified to the P&L that have to be credited or which are credited or debited have to be added or subtracted. Are we clear? However, for certain items such as revaluation of assets, plant, property, or equipment, this is to be included in the book profit at the time of realization or the transfer of the asset. Similarly, gain and losses from the investments in the equity instruments which are designated at the fair value are not to be added or reduced, but are to be included in the book profits at the time of realization or disposal. Clear? Or you can write it here. When the asset is retired, disposed, released, or transferred, include in book profit. Okay, for both of these. Fine. Next adjustment which you have to make for the Ind AS compliant companies is on account of the demerger. So this is the first adjustment to OCI. Second is for the demerger. What is the adjustment? So at the time of demerger, the amounts which are debited to the P&L on distribution of non-cash assets to the shareholders, that has to be added, and you have to reduce the amounts credited to the P&L on distribution of non-cash assets. So add amount debited on distribution of non-cash assets to the shareholder less amount credited on distribution of non-cash assets to the shareholder. Because the Ind AS 10 provides that any distribution of non-cash assets to the shareholders have to be accounted at the fair value. So there will be a difference between the carrying value and the fair value which is recorded in the P&L account. So you have to add or less those amounts only. So the reserves which are debited at the fair value to record the distribution, that have to be added back, and the amounts which are credited have to be reduced. Clear? Do you have any doubt? So this has to be excluded from the book profit. Clear? Now, in case of the first time adoption, if the company is adopting the Ind AS for the first time, then the book profit of the year of the convergence, the first year in which the company is adopting, and each of the 4 years will be increased or decreased by the 1/5 of the transition amount. So when the company is going for the Ind AS first time, the company would prepare the Ind AS financial statements for the reporting year with a comparative financial statement for the previous year. And the company is required to make all the Ind AS adjustments on the opening date of the comparative financial year. And it has to present the equity reconciliation between the previous accounting standards and Ind AS amounts, both on the opening date as well as on the closing date. Right? So there will be certain adjustments which will be there for the first time adoption. And 1/5 of the transition amount has to be increased or decreased for the 4 years, plus the year of the convergence, which is for the period of 5 years. Are we clear? So transitional amount third adjustment is for the transition amount, add or less transition amount, which is 1/5 for year of convergence plus 4 succeeding years. However, this would not include certain items again. Now, what is not exactly included in the transition amount? So the amount adjusted in the other equity will not include amount adjusted in the OCI, which shall be subsequently reclassified to the P&L, right? So amount adjusted in other equity, excluding capital reserves and security premium on convergence date, excluding amount adjusted to OCI which shall be reclassified to P&L. Second, revaluation surplus for assets. Revaluation surplus for assets. So revaluation surplus, which will not be again included. However, the actual amounts on the disposal or realization will be included, right? Then gains or losses from the, again, equity instrument carried at fair value. Gain or losses from investment in equity instruments carried at fair value. Are we clear? Then adjustment relating to plant, property, equipment, and intangibles recorded at fair value. Adjustments to property, plant, equipment, and intangibles recorded at fair value. Adjustment relating to subsidiaries, joint ventures, and associates recorded at fair value. Adjustment relating to subsidiary, joint ventures, and AEs at fair value. And finally, the adjustments relating to the cumulative translation differences of foreign operation. Adjustment relating to cumulative transition difference on foreign operation. Right? Finally, the last adjustment is add or less the adjustment on the differences arising or on the accrual or actual gain or loss on the disposal or transfer of the foreign operations. So add or less gain or loss on disposal of foreign operations. This is the actual gain or loss which you have to record it. Okay. So what are the 4 adjustments which you have to make for the Ind AS compliant company? First is the OCI, items that will not be reclassified to P&L, add all the amounts credited, less all amounts debited. No adjustment for revaluation or gain or losses on investments in equity instrument at the fair value. You will have to do it when they are actually retired, disposed or transferred. Demerger, add or less the amount debited or credited on distribution of non-cash assets. 1/5 of the transitional amount for a period of 5 years. And finally, add or less gain or loss on disposal of the foreign operation. Clear? Any questions, any doubt? Any questions, any doubt? For financial instruments, it's not there. Jacob, in practical life, we do it as per the normal provisions and we also calculate the MAT to see if the MAT is higher than the normal provisions. We do that and the companies do go under the MAT. Kaushiki, 1/5 of the transition amount is allowed because the transition adjustments which are made that may have a long impact and therefore it is allowed for a period of 5 years. Like why we have 1/5 for preliminary expenditure. Any question? Yes, Vinay, for the financial instruments which are there, so the profit may include the mark-to-market gains or losses on account of fair value adjustments on various financial instruments recognized through the P&L account, which is the fair value adjustments which are there, right? Now, whether they have to be added back under the 115 JB book profit or whether they require any adjustments. So the mark-to-market gains recognized through the P&L on the fair value adjustments to the financial instruments are included in the book profits, right? So CBDT in this case has clarified that the mark-to-market losses on such instruments will not require any adjustments because there is no specified adjustment for that. However, in case there is provision for diminution or impairment in the value of assets other than the fair value adjustments on the financial instruments, right? Then the existing adjustment which is there for the provision which is added back on the diminution will be done. Are we clear? Any other question? Okay. If MAT is higher than the normal tax, yes, MAT should be paid, Jacob. That's correct. Any other question? So once you have to go under the MAT, you will have to also furnish the report from a CA certifying that the book profit has been computed in accordance with the MAT provisions on or before the due date of the audit report, which is the normal audit report due date, which is there 1 month prior to the due date of return filing. You will have to submit the form from a CA also certifying the book profit corrected, that it's a correct or accurate book profit which has been computed, right? Similarly, if there are any losses in respect of any previous year, if there are any losses under 72, 73, 74, that shall be allowed to be carried forward. Clear? And all the other provisions of the Act will apply in a similar way as they apply to the normal provisions. So that means you will have to compute the advance tax, you will have the interest computation. If you have not paid the advance taxes, all of that will similarly be applicable. Are we clear? Any other question? Yes. Deferred tax amount that is there relating to the OCI items. So deferred tax we have already seen, right? Other than that, there is no adjustment which is required. So deferred tax in the normal category, you will add or less the deferred tax asset or liabilities, right? Now, with respect to the OCI items, again, there is a clarification from CBDT that adjustments on the transition date may have a corresponding impact on deferred taxes. So should that be considered for the transition amount? So that shall be ignored for the purpose of computing the transition amount. The CBDT has given the clarification for that, Vinay. Clear, Vinay? Any other question? As I said, we will do certain case laws also on MAT tomorrow or day after tomorrow when we have the next class. I think we have it on Monday. And we will solve several questions relating to this as well. Not relating to transition also, if you see, whenever we already have the adjustment which is there. So that will be considered. Other than that, in transition, you will have to ignore. Yes, Jacob, there are amendments which we are going to cover specifically. Any other question? Vinay, if it is not for transition, we already have the adjustment. If it is only relating to transition, then there is CBDT clarification in that regard. Clear? Third adjustment only apply when first year for Ind AS, which is the transitional amount, first year and for the next 4 years. Clear, Kaushiki? 115 JB, Jacob, MAT is covered. We have already written explanation to 115 JB provides for calculation of book profit. Okay. So, thank you so much. We'll meet on Monday again and we will cover the rest of the topics on this. But I would suggest you to revise because we are going to solve few questions on MAT and this OCI adjustments which are there. So I would want you to be thoroughly revised before the next class. Thank you so much.